Hello and welcome to Darren Tawny's latest investment and planning video. Today I'm delighted to welcome Nersen Pillay, Investment Director at Royal London on their multi-asset team. A slight change from previous videos, and we've enlisted the help of clients just to put together some questions that I'm going to be putting to Nersen today. We'll be covering topics such as US, UK economies, interest rates, pensions and investments. Nersen, I'm delighted to see you today. Good morning.
Morning, Darren. Thank you for inviting me.
And for the benefit of our clients, could you give an overview on fund management and what it involves, please?
Sure. So fund management is all about creating funds which meet objectives. So your clients have a risk appetite and a return objective, and we can create different mixes of assets to achieve that over the medium to long run. So the first thing to get right is the underlying strategic asset allocation, which is a core portfolio, which is all about meeting the long-term objectives of anybody in that fund. The second thing is then to be active tactically with it. So sometimes going underweight or overweight. So sometimes having more US equities and less in the UK, or maybe sometimes having more in UK bonds and less in emerging markets. So objectives, strategic asset allocation, and then active tactical asset allocation.
Interest rates have been a hot topic now for a number of years. So from Royal London's point of view, what are your expectations in the short to medium term for interest rates, and how may this affect the markets in general?
Yes, thank you. So we had a long period of near zero interest rates with quantitative easing. So that was an unusual period in economic history, and everybody's got to get used to the idea that interest rates are not going back to those levels. That was not sustainable. That was supposed to be a pretty short-term emergency measure. Having had low interest rates for a long time, the economy, with the pandemic locking down and then opening up, experienced inflation rising. Then Russia invaded Ukraine and inflation rose further. So interest rates had to rise very sharply from abnormally low levels towards actually more normal levels. So the US increased interest rates 11 times to around 5%. Having gone through that inflationary period, those interest rate increases are now successful in getting inflation closer to target, which for the Bank of England and the US Federal Reserve is around 2%. But we're not going back to zero inflation, so we shouldn't expect interest rates to fall right back. So recently the US cut interest rates by 0.5 percentage point, and that was a positive for markets because markets are wanting to see easier monetary policy, lower interest rates, now that inflation is more under control. So on one level, interest rates coming down is good. For the consumer, more money in your pocket, less debt interest to pay. Same for the corporate, and also for governments, as bond yields are related to interest rate levels and bond yields fall. So the general point is falling interest rates should be a positive for both the growth that equity markets want to see, but also for inflation being under control from the central bank point of view, and that encourages bond markets.
The Royal London funds seem to have held up really well over recent years. So what's the secret to your success?
So we spoke about diversification in the strategic asset allocation, the core portfolio. Diversification is absolutely key, and not all funds are diversified in the same way. So sometimes you can find that the diversification discipline holds you back, but it's worth sticking to it because over the medium to long run, that discipline helps you ride out market volatility. So if you look under the portfolios, you'll find strategic asset allocation, which is what we think a global multi-asset portfolio for a UK-based client should look like. So compared to a market cap-weighted fund or to some active competitors, you'll see that we are not necessarily as structurally exposed to the US as some may be. We are at a weight that we're happy with, and we can go overweight and underweight relative to our core holding. But you may well find that a Royal London multi-asset fund doesn't have as much US exposure as some competitors. And you may find that we've chosen to have a bit more UK exposure. Plus we have commodity exposure, which includes metals, agriculture and energy. We also have our own Royal London property teams, property holdings, direct holdings of property, which benefit the portfolios long term. So we look different in our regional equity exposures. We look different because we have commodities, we have our own property fund, and the way that we create the blend. And on top of that, we do go overweight and underweight. So getting the strategic asset allocation right is the first thing. And the second thing is being active tactically.
Thanks, Nersen. So what are your views on the American economy? I know the Federal Reserve have cut US interest rates quite recently. So will you be making any changes or adjustments?
So the US economy has been extremely successful post-pandemic compared to Europe, compared to China. It's avoided recession despite 11 interest rate increases, and now rates are beginning to come down. So the prospects for it are improving. They've proven themselves very strong in innovation: Google, Amazon, Tesla, Zoom, Netflix. So they're leading globally. They have good demographics, and obviously a lot of people want to move there and live there and work there and invest there. So with the interest rate cuts beginning, that gives us hope of a soft landing for the US economy, which then could help global growth improve into next year. And that could lead to the equity market rewarding earnings growth based on a stronger US consumer as rates begin to fall. There are, however, geopolitical risks that could give either growth or inflation shocks to challenge that rosier picture.
Well, staying on the US theme, there's obviously a lot more airtime being given to the US elections coming up this year. What are you making any adjustments with your investments, or how may the US elections impact on investments in general?
So the US election, on one level, it doesn't matter who wins for the markets, because both will still be borrowing to fund government spending. One may borrow more than the other, but they'll both be borrowing. So we're not facing a choice between huge spending cuts or an increase in spending. There's not that much difference between their fiscal policy. Monetary policy is in the hands of the Federal Reserve, so interest rates are beginning to come down. So in the absence of any inflation shock, then that should continue. Perhaps the bigger risk from the US election is to do with confidence. So already there have been 2 attempts on Donald Trump's life in this campaign. If something terrible happened, that could obviously rattle the confidence of markets. Last time when he didn't win, there were riots and there was instability. So post-election, that could be another point where the confidence of markets could be weakened by any instability. So we're watching closely to see what's happening. Hopefully nothing bad does happen, but the main issue really isn't economic. It's probably more to do with confidence at this point.
Have you made any changes in general in your investments since the UK election results?
So our portfolios, the governed portfolios, are global multi-asset portfolios. So the UK election's impact on the whole portfolio is relatively small. The bigger things that are going on are global. So interest rates are beginning to fall globally, including here, but more importantly in the US. And that has made us keener on bonds than we were because as interest rates fall, bond values can rise. So that's one thing that is happening. But that is more really a global phenomenon and related to the Bank of England's success in getting inflation down. The UK election itself hasn't had much impact on what we are thinking or doing in what is a global multi-asset portfolio.
With hindsight, are there any investment opportunities that you may have missed out on that you look at differently now?
So would have been great to buy a lot more stock in Nvidia a couple of years ago, I suppose. But I don't want to sound arrogant or complacent, but I think my answer should be no. Because what we're trying to do is to build diversified portfolios that deliver medium long run. So if something shoots up in a year, that doesn't really matter to what is achieved medium long run. So firstly, what are we trying to achieve? We're not trying to max performance short term. We're trying to deliver consistent returns medium long run. Secondly, we spoke earlier about diversification and the strategic asset allocation. So more important than having anything which has done extremely well is having the right underlying diversified portfolio to meet your medium long-term objectives. So getting that right is the key. Now, the way we build that strategic asset allocation portfolio, we have access to all of these stocks, Nvidia, Apple, etc. Maybe it would have been nice to have much more in them, but we do have exposure to them and we have benefited. So I like to say we want to be the tortoise, not the hare. We want to deliver over the long run. And that's by not being greedy, not racing ahead, but having the right risk-adjusted returns, medium long run.
If things escalate in the Middle East, how could they affect UK pensions and investments? And are you looking to make any adjustments to counter that?
Yes, so the Middle East is obviously at a critical point and everybody's working hard to try and avoid an escalation. The risk to investment markets is primarily through the energy cost inflation route. So if there's an oil or gas price shock, then that could lead to inflation stopping its downward trajectory, going up, and that could lead to interest rates actually having to rise. So that wouldn't be good either for equities nor for bonds. And we would have to then become more defensive. Now, in a global multi-asset portfolio, one advantage we have is that we can have commodity exposure. So if there is an energy shock, we own some exposure to oil and gas, and that can protect. We also are highly diversified. That in itself is a protection. We also are able to say that if energy prices, for example, are increasing, we can increase exposure to that sector and decrease exposure to other sectors which may be hit. For example, consumer discretionary spending, where a consumer facing higher interest rates and higher energy costs might spend less. So we might reduce exposure to that sector and increase exposure to the energy sector. So the primary risk for investment markets is all about inflation and interest rates and how that impacts the consumer, corporates, bonds and equities.
The Chancellor's announced recently that she's looking to invest billions in the UK economy by unlocking money held in pension funds. How do you see this working?
Yes, so in our portfolios, we design an underlying strategic asset allocation which allocates to the US, to Europe, to the UK. And that is done on the basis of a lot of work, looking at returns and risk and currency, etc. So we don't want to invest in the UK for political reasons, but investors globally will invest more in the UK if it becomes attractive to do so. So I guess what investors generally want to see are measures which make it more attractive to invest in the UK, and then investment will flow naturally.
What are your expectations for the upcoming autumn budget? How do you see this impacting on pensions and investments in general?
Thank you. So we don't have any special insight into what will be announced, but the media has been talking about various taxes and changes that we could see. What investors need is some degree of consistency and stability, and that's what I guess everybody is hoping for. For pension investing, what we need is a clear view of how policy is going to evolve over time.
Thanks, Nersen. So where do you see as key growth areas for pensions and investments in the coming years?
Growth is obviously very important for meeting objectives, and so that's something we're interested in finding. Being global is very useful because we can get emerging market exposure. So where we have aging populations, even falling populations in some parts of the developed world, but also in countries like China, having emerging market exposure outside China enables us to access populations in which there is strong growth, and that means millions of people buying their first bicycle and then motorcycle and then car, but also in those countries, lots of people buying their first Rolls-Royce. So emerging markets are very interesting long-term for growth, particularly outside China, because China has developed incredibly since the early 80s when it began its major reforms. So emerging markets are interesting, but the developed markets are also interesting because there you might find greater innovation in technology and pharmaceuticals. So if you look at Ozempic being a huge success for a Scandinavian company, but also if you look at AI leading to incredible growth for companies like NVIDIA. So growth is going to be in various places. Being global and being multi-asset means that we have a great opportunity set to find growth, but in a risk-controlled way.
Thank you very much for investing your time and visiting us at our Kettering office today, Nersen. I know from my point of view, and I'm sure our clients will have found the information very informative and interesting. So thank you once again.
Thanks, Darren. Good to see you again.